16 of 21 series are aligned with an acceleration regime this morning. That is a moderate level of agreement across the engine's macro inputs. The current macro regime is acceleration mild, with a confirmation score of 16 out of 21. In the framework's language, acceleration mild describes an environment where growth momentum and inflation momentum are both accelerating at the same time. The math has growth running at about plus 0.02 in the composite and inflation at roughly plus 0.01, each measured as a rate of change against their own histories. The coherent score is in a moderate band, and the confirmation score of 16 out of 21 has historically persisted in roughly 47% of comparable cases over 3-month windows, a description of past behavior in the data, not a forward statement. Compared to last week, confirmation has firmed, with more series aligning to the acceleration profile, even as some activity indicators, such as regional business surveys, have softened. Historically, markets have often felt mixed in environments like this. Growth-sensitive assets and inflation-linked exposures tended to pull in the same direction, while duration and credit repriced to reflect the dual pressure, a record of past behavior only. Let's walk through 4 signals the framework is watching. First, Treasury yields. The 10-year note is around 4.71%, with the 2-year closer to 4.37%, leaving a modestly positive slope in the curve. The engine maps this to a green momentum label for growth rates. Mathematically, that means the composite of growth-linked series is rising, with the curve no longer deeply inverted. Investors watch this because the balance between short-term policy expectations and long-term growth and inflation views sits directly in these yields. The question it raises is simple. Does this level of long-term yield, in the context of higher inflation readings, change how much duration risk or growth exposure feels comfortable? In our framework's reading of comparable periods, this roughly coincided with stronger performance from cyclical sectors and pressure on long bond prices within 1 to 3 months, an observation under our methodology, not a forecast. What would challenge this read? A renewed flattening of the curve driven by falling long yields and softer growth data. Second, labor. Non-farm payrolls and related employment indicators in the composite are tagged red for momentum. Quantitatively, their rate of change has cooled relative to prior months, even though absolute levels remain high. Markets watch the labor market because it anchors both household income and the central bank's assessment of slack and wage pressure. The question for allocators is whether a slower pace of job gains changes the comfort level with cyclical exposure or earnings assumptions. In our framework's reading of comparable periods, this roughly coincided with more uneven equity performance and wider dispersion across sectors over the following quarter, a record of past behavior, not a forecast. What would challenge this? A clear reacceleration in hiring or a renewed drop in jobless claims that turns the labor momentum back toward neutral. Third, credit. High-yield credit spreads, the extra yield investors demand to hold riskier corporate bonds, are marked red, reflecting unfavorable momentum as spreads have widened from recent lows. Markets focus on this because it is a direct barometer of perceived default risk and balance sheet stress. The question it raises is whether the current pricing of credit risk feels consistent with one's own view of corporate resilience. In our framework's reading of comparable periods, this roughly coincided with slower issuance and more cautious behavior in lower quality credit over subsequent weeks. An observation under our methodology, not a forecast. What would challenge the read? A sustained narrowing of spreads back toward their tighter ranges. Fourth, equity sectors and commodities. Technology shares have recently been weaker, while materials, real estate, and gold have shown relative strength, and oil prices have swung lower on geopolitical developments. The engine labels the momentum in inflation-sensitive assets green, with a clearly positive rate of change, while long-duration growth sectors show more mixed readings. Participants watch this rotation because it tells them where markets have been compensating investors for inflation and where higher rates have been biting into valuations. The question is whether this particular mix across sectors aligns or conflicts with the risk posture already in place. In our framework's reading of comparable periods, this roughly coincided with continued leadership from real assets and more choppy performance in high-growth sectors over the next several weeks. A record of past behavior, not a forecast. What would challenge that pattern? A decisive, sustained drop in realized inflation or an easing in policy expectations that re-anchors discount rates. The conditional map adds two explicit if-then structures. If the 10-year Treasury yield crosses 4.45% and holds that level for 5 consecutive sessions, in our framework's reading, the inflation composite historically showed acceleration in roughly 9 of 11 comparable conditions, a historical characterization, not a forecast. Under the current acceleration mild regime, such a move would mathematically strengthen the case that the environment resembles past expansion to acceleration transitions. If the Fear and Greed Index drops below 15 and holds there for 5 consecutive sessions, in our framework's reading, the regime confirmation score deteriorated in roughly 7 of 9 comparable conditions. Again, a historical characterization, not a forecast. In the present environment, that kind of extreme risk aversion would historically line up with more contested regime signals and a regime watch posture in the math. The map is live. These conditions are being monitored daily across all 21 series. Atlas is the automated, rules-based engine inside Given Analytics. It does two things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed 4-layer mathematical framework: price structure, rate of change, risk regime, and market participation, across 407 liquid symbols every trading day. When all 4 layers agree on a symbol, Atlas records it as an upside-aligned or downside-aligned condition under the framework, a reading of how the 4 layers line up, not a trade. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside Atlas. They are separate outputs. The regime does not pick the symbols, the 4 layers do. Members use Atlas to study how the framework has recorded conditions across prior environments, as historical behavior, not as trade selection. Atlas runs the framework. You study the outputs and environment. You decide what to do next. That use of Atlas is explicitly may, potential, and educational, a way to frame the data, not to dictate actions. The morning brief is the public surface. The live Atlas dashboard shows the full 21 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the Atlas outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com. Free to try, no credit card, for the first 500 founding members.